Kaizen is marketed as it's designed to produce 3 times more income. That's awesome. Like that, I'm sold. Nowhere does it say that cost is related to time, because God forbid if something happened, if there's emergency, you want 3 times more income, you gotta wait 15 years. And that cost is critical because time is the most valuable asset that we have. This kind of speaks to and goes back to the goal. What's the goal? What was the point? What was the purpose of getting a product like this? In most cases, it's related to, I need access to my money. Like I didn't put a lump sum plus a monthly amount into this product and not want access, because God forbid if something happened, if there's emergency, it's about leverage. I need to be able to pivot. So this is another vehicle that I am using to be able to pivot when I need to. So liquidity from a Kaizen perspective, it's severely restricted because of that 15-year piece. And again, what is the 15 years for those who may have just jumped in? You can't access the cash value inside of your Kaizen until the borrowed money you're using is fully paid off. And depending on how the market does, may dictate the time frame required to be able to pay it back. And again, when we jump into the illustrations, you'll see exactly what I'm talking about. For the leveraged IUL, again, built-in participating loan, access begins as early as year 2, and it's flexible. Meaning if something happens, if there's some emergency that I need to be able to adjust to, I can access my cash value like I can in any cash value life insurance policy to be able to use it. And how about also being able to access your funds when and why it matters? Meaning, let's say I'm leveraging this policy for income and there's a market downturn. I have the ability to adjust what it is I'm receiving because maybe my pension is heavily impacted. So therefore I can now increase what I'm receiving inside of this policy and vice versa. So it's a faucet that I can turn on and off and make adjustments as I need to, not just as I'm receiving distributions, but also as I'm contributing. Let's say I'm contributing $10,000 a year today, but I lose my job tomorrow. Can I adjust my policy to reduce what it is I'm contributing? Well, absolutely. And not only that, if I'm putting in $500 a month, but now all of a sudden I got a promotion or I've got a tax return or I want to make an adjustment so that I can add more because now I'm doing velocity banking and I've got a HELOC that I want to be able to dump funds in, I can adjust in the positive direction. Again, that ability to pivot is important. And then as it relates to infinite banking, and I think there's an opportunity to reframe infinite banking as well. And I think reframing it as a family bank, meaning can I access the cash value in this policy, whether we're talking Kaizen or we're talking a leveraged IUL, can I access the leverage in this policy to do what I need to do externally? And that is become my own bank. Are my assets protected? Having liquidity as quickly as possible and being able to recycle that leverage over and over and over again. Do I have this capability? And the truth is you don't. You don't inside of a Kaizen strategy simply because of your access or your lack of access to the liquidity inside of your policy when you need it. And so is it compatible? In short, for Kaizen, it's not. Delayed access prevents banking functions, rigid loan structure limits flexibility, and capital recycling is impossible during the repayment period. And again, the difference between the two, one, I have control. One, I have the ability to adjust and pivot when I need to, and the other one, I don't, because I'm subject to what the restrictions the bank provided. And again, I get it. The bank provided leverage dollars to be able to build cash value faster, which is awesome. But as a result, I am restricted in what I can do. And I think here's the root of that. The reason you're restricted inside of a Kaizen approach is because the bank wants their money back. So the bank needs guarantees that they can get their money before you start accessing yours. So it's just as simple as they're a loan shark. They're a loan shark, they charge you an interest rate, and 9 times out of 10, that loan shark wants his money before you do anything else, because if they don't, you might have to watch out for your kneecaps because they're coming for you. So the bottom line is, what's the criteria, what's the structure around a strategy like this to make sure the person that provided you the sum of money can get their money back? What's the guarantee? What I wanted to do now is kind of jump into specifically, and here I'll show you the full. This is the illustration for the Kaizen structured policy. Again, it's an index universal life insurance policy using bank funds. I'm gonna drill in, but I just want to let you see the full picture of what the illustration looks like. And let me set the stage a little bit. This strategy has been based on a 34-year-old, and they're putting in 5 years of a premium, and that's it. Again, 34-year-old, great health, putting in a dollar amount for the first 5 years and not putting in one dime. What are those dollar amounts? So this is the contribution from the client. So they're putting in $23,450. Why it's not 24 grand? I think it's because $550 is being taken as commission, because I believe the contribution is actually 24 grand, but I won't go into that. 23,450 is the contribution amount. And they're only contributing for 5 years. This is it. But notice, starting in year one, there's a leveraged dollar amount being added of 18,000. So 24 grand plus 18 grand, which makes a total of $40,000 going into the policy. To me, that's awesome. Leverage starts in year one. If there is a win for this Kaizen compared to the other strategies that we talk about, is being able to add leverage as early as year one. That's awesome. So 18,000 year one with the contribution amount of 23,450 coming from the client. So these two dollar amounts added together is 40,423 what's being added to this policy, and that's happening for the first 5 years. And then for the next 5 years, nothing is going in from the client, and the bank is adding $40,000 of contribution for the next 5 years. $40,000 times 10, there's a total of $400,000 being put into this policy from a bank. You've put in whatever this dollar amount is. I think I did that math earlier. 23,450 is about 117 grand. So there's about $117,000 being contributed by you, and then an additional $40,000 a year for 10 years, $400,000 added for the bank. So these two dollar amounts are working for you first 5 years, and then the remaining 5 years, there's only the leveraged dollar amount going into this policy. In looking at it, I like this structure simply because I have other people's money working for me. And these are the illustrated interest rates. Notice how it starts out at about 2.75%. It increases over time. And again, this is a guesstimate. It's an illustrated amount. So this is based off today's rates and whatever they anticipate tomorrow's rates to be. So my point is, this can change. But as of right now, the interest rates don't seem too bad to me. And again, here's the piece. You cannot access any cash value created by this contribution plus this contribution until all $400,000 are paid back. How long does it take for that $400,000 to be paid back? Well, notice at year 15, this shows interest rates through year 15, and at year 15, the bank receives their $400,000 back that was used as leverage. And at this point is where you can actually start using this policy. So again, some of the restrictions associated with this strategy is you've contributed 5 years, you had to wait a total of 15 before you could just start using your cash value. And now, what is that cash value? So this is the estimated net cash value. Basically, this is the amount, because it says estimated net cash value or cash surrender value after the bank loan. So what this is saying is this is the money you have access to. This column is saying this is the illustrated year-end projected cash accumulation value, meaning this is how much money is actually working for you in the policy. So dollar amount working for you, dollar amount you have access to. So you've put in 23,450 of your money in year one, and you have access in year one of about 15,894. The fact that you have access to 15,894 really doesn't matter. Why? Because for the first 15 years, you can't access or use any of these dollars. So you can go into your online account and you can see that your account has cash value in it. I think that's a positive. But until this loan amount right here is paid back, you can't access any of these dollars. So let's go back to the goal. If the goal is to be able to access your cash value to be able to use to help a child through college or buy cars as people turn 16, or
help them buy a house, help them buy their first for a down payment,
leverage to be able to buy real estate, you cannot access any of this cash value that has grown inside this policy until year 15. So normally I like to talk about where you break even inside of a policy like that, right? If I put in 117,000, when do I have 117,000 working for? Well, break even doesn't even matter because I cannot access these funds for the first 15 years. Hard stop. So where you break even does not make a difference in a strategy like this because this is a long-term play. One other thing to note, and this is the projected death benefit, meaning the amount that you're using, 23,450 plus the leverage dollar amount of 18,323 for a total of 40 grand. That $40,000 is buying about 1.5 million in life insurance, and the death benefit is increasing, which means it's an option B policy. If you've been on any of the other lives, and I talk about how structure matters, buying the least amount of life insurance legally possible and making sure that death benefit is increasing as you're contributing to it. This is the least amount that you can buy for 40,000, and the death benefit is increasing to a certain point. And so I think everything is in line with what I would expect the structure to be. The only issue is, and I'll zoom out one last time, is you can't access any of this cash value at this point for the first 15 years, but from year 15 on, you can. And one other thing I'll highlight is here at age 65. At age 65, what this is saying is I want to start taking a distribution. At age 65, I want to start taking distributions of $83,000 a year as income. So what this is saying is based off the amount of cash value that has been accumulated by age 65, and you just have to take my word for it, this is age 65, and this is the amount of cash value available, which is 779,000, so let's call it 800 grand. What this is saying is, hey, if I've got 800 grand in cash value, I want access to at least 83,000 a year in income for the rest of my life. I think on the surface, if this was me looking at this policy and I didn't know any better, I'm going to say this isn't a bad structured policy. There's some things that I just simply dislike. That doesn't make the policy bad. Meaning, I dislike the fact that I cannot touch my cash value. But if I know this up front, and my goal is to be able to produce income at age 65, and again, I know this up front, this is a set it and forget it for me. I'm putting in this 23,450 for the first 5 years, and I'm not putting another dime into this product. And then at some point, I'm going to be able to take $83,000 a year in income.
Could you put more in?
So that's a great question. I'm going to say this policy is structured such that you cannot. Meaning the way this leverage is structured, I'm going to say if you were putting more in, that's less leverage used, which means more leverage could be used later, which means what? It's longer for me to be able to touch my money. So to me, if you were to put more in, it causes the policy to extend. So can you? Probably. Should you? Again, if I don't accept the fact that I got to wait 15 years to touch my money, I damn sure don't want to wait 20. So my point is, if you're wanting to add more, it may make more sense to start a new.
Wow, here we go. A pack of policies. It sounds like a whole life.
And what I appreciate about this, what I'm seeing here is I wouldn't have been able to duplicate this in my head, but it is very clear that, hey, you can, there's a minimum amount of time you have to contribute into a Kaizen. And I think that minimum is 5 years. And there's a maximum amount that you're able to contribute for a max funded policy with least amount of fees. And so I think this all tracks. My point to you is this: can we do better? Okay, this is what the Kaizen offers. Again, just to restate, by year 5, you would have accumulated about 101,000 in cash value. By year 15, you would have accumulated about 236,000 in cash value that you can use. By age 65, you would have about 802,000. So again, 101 at year 5, 236 at year 15, about 800,000 at age 65. Is that good?
Yeah. Can you scroll down? Because that's what the questions in the chat. Nathan's even asking, like, is there enough to maintain the cash value once distribution? Well, he's saying distribution.
Well, absolutely there is. And why is that? So to have that discussion, we need to, let me focus on a column here. We need to focus on the illustrated year-end projected cash value, accumulation value. Accumulation value is the key to understand whether or not the policies can sustain what it is you're wanting to do. So it's all about the accumulation value. How is the accumulation value column created? It's created by your contributions plus the leverage contributions and its growth. And notice, your contributions plus the leverage contributions, I'll zoom in a little bit more. Once the loan is paid back, that leverage dollar amount is about 656,000. Because there's another almost 5, 10, 15, there's another 15 years before distribution starts. So here's age 65. So because you didn't put any more into this policy, you've got 1.7 million in cash or in accumulation value. You got 1.7 million in total available working for you. 1.7 million working for you to start taking 83,000. And 1.7 million working for you to take 83,000. Can 1.7 million create enough cash value for you to take this 83,000 for the rest of your life? And the short answer to that question is yes. Here I am at age 90, and the amount of accumulated value sitting here at age 90 is $8 million. So the policy is still continuing to grow based off this leveraged dollar amount that was sitting here. So can it? Yes. I don't dispute that. But I think, Nathan, that's a great question to ask, because implosion is one of the issues that people have with IULs. Now you got to remember, this is illustrated. This isn't actual. This is based off an illustration. There's a lot, especially with this administration, there's a lot that can happen with interest rates and things of that nature. Because again, where is this borrowed dollar amount coming from that's building this accumulation value? This borrowed dollar amount is coming from a bank. Banks are much more susceptible to what's happening in the market versus you contributing a certain dollar amount into this policy and you leveraging your own money. You're creating collateral based off the money you've contributed. The dynamics of that borrowed dollar amount coming from a bank is way more impacted by external factors, the market and administration and tariffs and all of those kind of things. So my point is, I think the concern is still very valid. But looking at the math in this strategy, in this policy as it sits, there's definitely enough to sustain. All right, great question though. How does this compare? What does this look like in, and again, I'll just let you see the whole thing. What does this look like in a properly structured index universal life insurance policy with leverage? I'm using the MPI strategy in an index universal life insurance policy to be able to duplicate what would happen. And so let me zoom in. And let's be clear. Same age, same health rating. This is that contribution amount. I'm only contributing for 5 years. $23,450, same dollar amount for 5 years. And when I contribute year one, again, this is the leverage IUL strategy, was built on the foundation of MPI, which says what? Let me go back to it real quick, which says this. I'm contributing a certain dollar amount, and then starting in year 2, or year 3, wherever that happens, there's a certain dollar amount added, and these two dollar amounts are now working for me. So this is the strategy that I'm applying. So when I apply this strategy, what happens, and just if we were to just look at the first 5 years, I put in $23,450 in year 1. It's the same dollar amount being put into the policy, so no leverage. Put in $23,450 in year 2, same dollar amount working inside the policy. When I go to put in $23,450 in year 3, the life insurance company adds $23,450. So now both of these dollar amounts are working for me at year 3. So both of these dollar amounts is what's going in as brand new principal. At year 4, the exact same thing happens. Both of these dollar amounts going to my policy working for me. But at year 5, something special happens. At year 5, not only am I able to borrow everything from year 1, but at year 5, I'm able to borrow everything from year 1 and year 2. So both of these dollar amounts, I'm now able to leverage. So $23,450 times 2 is $46,900. So $46,900 plus the amount that I've contributed. Now both of these dollar amounts are working for me at year 5. But from year 5 on, I am not contributing another dime. So I'm following the same structure as this Kaizen. But the cool part about this strategy is, even if I stop contributing, there's still leverage that's accessible to me, and that leverage is being contributed from this point forward until I decide to stop. Nathan may be asking, how is that possible? It cannot happen if I haven't built up enough collateral in my policy to allow this leverage to be added. Meaning, what was the agreement with the life insurance company? If I fund my policy consecutively in year 1, and I can fund my policy consecutively in year 2, starting in year 3, the life insurance company, the agreement that I have with the life insurance company says I can borrow everything from year 1 and add that along with my contribution at year 3. So that's where these two dollar amounts come from. I didn't have to qualify for it, meaning I didn't have to go to a bank. I didn't have to have a great credit score. I didn't have to have a great DTI. I don't have to have a net worth of $1 million or more, none of that. The agreement is, if I've contributed consecutively in year 1, in year 2, everything from year 1 can be added to year 3. Then I can do the same thing in year 4. But if I do the same thing in year 4, I met the exact same obligation for the second time, meaning for year 3, I had to have contributed year 1 and year 2. So for year 5, I had to have contributed year 3 and year 4. So because I contributed consecutively year 3 and year 4, that means now I can not only just borrow year 1 at year 5, I can borrow year 1 and year 2. Both of these dollar amounts can now be borrowed and thrown back into my policy as brand new principal. Because I didn't meet the obligation going forward, I can't add any additional leverage going forward from year 5 on.
But you could if you were doing this in the way that you would have structured this. This is just for comparison.
Well, this is apples to apples. If you would like to know what Donnell would do, we can cover that in a different live. But this is absolutely meant for an apples to apples discussion, because this was the question. How does my strategy that I received, how does this Kaizen strategy match up to a leveraged IUL, which is what we talk about on this channel. So it's meant to allow you to be able to see how each function. So again, no contributions after year 5, but I have room for whatever that MEC limit was. I have room for $73,050 from year 5 on. But because I'm not contributing, I can only fill that room with the leverage that I have, and that's $46.90. So what that means is from this point forward, I'm contributing $46,900 for the rest of the contributions into this policy. Okay, so what does that look like? We don't talk about the guaranteed column, because the guaranteed column is illustrated as though the market crashes every year. So we're not talking about the guaranteed column. We're not talking about the alternate scale column, because that is illustrated as though the market crashes every other year. We only talk about the guaranteed section. So this section over here to the far right is where we focus our attention. That's illustrated as close to actual as possible. So what I did was I cut up this illustration so it'd be a little bit easier to read, where I'm only doing the contributions and the non-guaranteed section. So again, it's the same illustration. I just cut it up so it'd be a little bit easier for me to zoom in on. Hopefully you guys are okay with that. When we talk about the first 5 years, I've contributed $23,450. Year 2, $23,450. So when I contributed the first $23,450, how much is working for me? So I put in $23,450, how much is working for me? What is that accumulation value? The difference between these two numbers are about $500. So what that's saying is between these two numbers, there's about $500 in fees. If someone wants to jump down that rabbit hole, we can do that later. But the bottom line is, majority of what I've contributed is working for me in this policy. Here comes year 2. Put in $23,450 in total, which is times 2, which is $46,900. How much is working for me? A little bit less than what I put in, but the fees are getting smaller. But then year 3, when the leverage kicks in, I've put in $73,050 in total from my money. That's how much I've put in. But when the leverage kicks in, how much is working for me? I have now broken even in this policy as far as how much money is working for me at year 3. As I mentioned before in the Kaizen, where's the break-even point in that Kaizen? Doesn't even matter, because I can't access my money anyway. So why does it matter here? Well, because of what I've contributed, I immediately have access to my cash value whenever I need to. So if there's a bill I need to pay, if there's a car I need to buy, if I want to put a down payment on a slow flip, if I want to, if I want to access my money to do infinite banking, I have access to my surrender value, which is my cash value, to be able to do so. So if we're talking apples to apples, I have access, regardless of what the dollar amount is, I have access to it if I need it as early as year 1. But because the leverage kicks in, I have access to more as the surrender value increases. And let's also be clear about this illustration. There are some limitations to what I can illustrate this surrender value against. I've covered this many times, but I just want to restate. Even though this shows in 5 years, I'd have $102,000 in liquidity, in accessibility inside this policy, this number is very much under, because I cannot illustrate any of this leverage at anything more than 5%. All of the other numbers are illustrated at 6.33. But I can't illustrate any growth on this leverage at anything more than point. It's very under-promising, but let's compare apples to apples math. So again, I kind of call these out on the Kaizen. I'm going to show you, but I'm going to call them out here. In year 5, I've got access to about $102,000. At year, I think I called year 10. I think I did year 15 when I paid back the loan.
That's right.
It was year 5 was $102,000. Year 15 rather, $445,000. 102, 445, and then by age 65, when it's time for me to start taking income, age 65, which is here, in the Kaizen policy, it was 800,000, taking 83,000 a year. In this policy, again, I haven't put a dime in this policy since year 5. I haven't maxed out the leverage available. I'm just using the leverage available to me. I'm illustrating this policy at 0.5% of the leveraged amount, meaning it is meant to underpromise. I'm still showing $1 million liquid by age 65. Let me show you again. These are both of the policies together, and I'm going to zoom in. These are the areas of focus: year 5, year 15, and age 65. Year 5, year 15, age 65 in both of these policies. If I was to just look at year 5, the amount of cash value available in the Kaizen versus, and again, the Kaizen, I started leverage year 1, and I'm putting in 40 grand a year each year. The amount of cash value available that I can't even touch. I couldn't use it if I wanted to use it, but how much is available? I've got 101 liquid versus 102. I'll call them comparable. Tomato, tomato. Year 15, I finally paid the loan off. I can now access these dollars to be able to go do infinite banking, pay bills, whatever I want. I've got about $60,000 more in the leveraged IUL compared to the Kaizen. Still gonna say comparable. But I go back to, I'm being illustrated 0.5% here. Like, I am limited as to what this growth looks like. About 60 grand more. When it's time to start taking income, this is when you need the money the most. Your objective is to be able to fire your job, hopefully. Put yourself in a position to where not only can you focus on what your latter years are going to look like, you can now be in a position to be able to help your family if you are the bank now. Which is better? 800,000 compared to $1 million.